Hi, and welcome back to the Business Career College video series. In this video, we're going to have a look at a fairly complex concept and really something that you don't need to be too concerned about unless you're dealing with business owners and doing some estate planning. This is an investigation of an unusual circumstance in Canadian tax law, and this is where we have some potential triple taxation. That is the same event that can create three separate tax outcomes. Specifically, we're looking at the taxation of a shareholder of a corporation on death. I'll paint a little picture here. We've got Lara, and Lara dies with this corporation. A while ago, Lara was running an active business. It doesn't really matter how long ago. She was running an active business, and she built up her business. And instead of selling her shares, at some point she had an opportunity to sell the assets of the corporation. This is pretty common. She sells the assets. She's left with a bunch of cash in the corporation. Another place you'll see this sometimes is people who build up corporations without really having the assets in them. Doctors are a very common example of this. Maybe orthodontists can do this, where basically the corporation has cash in it, which is really just residual from running the business. And now we're going to keep that cash in the corporation, invested, and so forth. So this invested cash has an adjusted cost base of $600,000, and there's about $1 million worth of investments here. Lara is the sole shareholder, and her shares have a 0 ACB. She's never had the opportunity to do anything to step up that ACB. Maybe the corporation never qualified for the lifetime capital gains exemption because of the passive nature of the assets that it holds. Whatever it happens to be, she's got no ACB. She dies. Lara dies. And we see that this is a deemed disposition, as we would expect of her shares at death. You'll remember that she's got $1 million worth of value in the corporation. That's what her fair market value for the shares will be. She's got no ACB. She can't use the lifetime capital gains exemption because these are all passive assets. So she's going to have $1 million capital gain. That'll be dealt with on her terminal tax return. So here we have tax number one. When her estate inherits these shares, it'll inherit them with the taxes paid by her terminal tax return. That's tax number one for Lara. And that'll result in $1 million capital gain, call it $500,000 of taxable capital gain then, and taxed at a tax rate somewhere in the vicinity of 50%, depending on the province she's in, about $250,000 in tax payable. Now, her estate, heirs, whomever it happens to be, the folks that are going to inherit Lara's wealth, they don't want to continue operating the company for whatever reason. Maybe you've got too many heirs to distribute this amongst. Maybe you've got heirs who don't want to have the complexity. Maybe you have heirs who aren't resident of Canada, and inheriting this Canadian company might not make sense for them. They say, we don't want this. We want to wind up the corporation. We're going to get rid of it. So the first thing that has to happen is the corporation sells the investments. And this will create our second tax. This is this taxable gain within the corporation. That's tax number two. And we have a little breakdown down below of the amounts at stake here. So this is going to result in, we had $1 million of fair market value, $600,000 of adjusted cost base, $400,000 of capital gain. That will create a $200,000 capital dividend account credit, which is good. We'll have a $200,000 taxable capital gain, and these numbers will vary a little bit by province. This is a pretty close breakdown. We'll call it $48,000 of non-refundable tax payable. That's money that's gone to the government, never to be recovered. and about $52,000 of refundable tax payable. That's money that will be available to the corporation once it pays a taxable dividend to its new shareholders. But right now, that $52,000 is sitting with the Canada Revenue Agency. They're waiting to hear that the corporation has paid a dividend to its shareholders, and only then will they start to shell that money out. And our third tax, so now we've seen two taxes, we have our third tax here. The corporation has to get rid of all this money. It pays $200,000 as a tax-free capital dividend. Great deal for the shareholders. We got $600,000 paid as a return of capital, and that amount has to be taxed when it's paid out to the shareholders. It was tax-free to the corporation, although at one point in the corporation's history it's been taxed. When we pay out that taxable dividend, that $600,000 taxable dividend, that'll trigger a refund of the $52,000 of refundable tax. And some of you might recognize this as Part 4 tax or refundable dividend tax on hand. $100,000 is the after-tax portion of the capital gain. That's also paid as a taxable dividend to those shareholders. And that $48,000, we already said we're never going to get that back. The corporation isn't paying tax now. Whoever it is that receives these $752,000 of taxable dividends is now going to trigger our third bit of tax. That's number 3. So to reiterate, we had taxation on Laura's death on her terminal tax return. We had taxation when the corporation disposed of its invested assets, and we have taxation for those who are going to receive now the corporation's proceeds as dividends that are paid out to those shareholders, whoever they happen to be. Now, there are some mitigating factors. This is where we would engage a tax lawyer, tax accountant, and we would make sure that we hammer some of this stuff out. It may be possible to reduce or even potentially wipe out the capital gain that arose at Laura's death. If we do a share redemption properly, if we use the estate to exercise the redemption within a year after Laura's death, it may be that we can create a capital loss there that can be carried back to offset the capital gain in the estate. That's a fairly complex outcome. Those of you that have watched the share redemption video will recognize some of those rules, that ability to carry back capital loss in the right circumstances. Of course, we have to respect the stop loss rules as well. This is quite complicated. If you're doing this in real life, you absolutely need tax lawyer and tax accountant. And really, with the types of events we're dealing with here, you would be foolish not to be using a tax lawyer and tax accountant all the way through. If the shareholders are willing to wait, if they don't need to wind up the corporation right away, if they can maybe wait a few years and keep running the corporation as this sort of investment corporation, they may be able to reduce or defer that tax liability. Again, you would need help from a good tax professional in order to facilitate that. I hope this helps. I hope we see the 3 taxes that arise at death, potentially, on the death of a shareholder of a corporation. Of course, if you're dealing with an active corporation, you might be able to mitigate some of those things as well. You might have lifetime capital gains exemption available. You may not have assets within the corporation that need to be disposed of. I tried to keep it simple here with using all passive assets. This is a fairly representative type of scenario. Again, quite complicated. You'll need lots of help with this in a real life scenario, but I hope this has given you a good eye to how this works. Please do enjoy your continued studies. Thank you very kindly.